Welcome to The Explainer. Today, we're breaking down a crucial concept every trader needs to understand: slippage. You know that moment, you click to buy, and the price you get is, well, not the price you clicked. So let's dive into why that happens, and, more importantly, what you can do about it.
So, here's the game plan. First, we'll nail down what slippage actually is. Then we'll look at its good and bad sides, figure out what causes it, and wrap up with some solid strategies to keep it in check.
So have you ever been there? You click to buy or sell at a specific price, but then the confirmation shows a slightly different number. You're probably wondering, hey, what gives? Well, that little gap between the price you see and the price you get, that's slippage, and it's just a normal part of the financial markets.
All right, let's really get into the fundamentals here. What exactly is slippage?
So in simple terms, it's the difference between the price you expect and the price you actually get. Think about it. In that split second it takes for your order to travel from your computer to the market, prices can shift. That tiny little delay is all it takes to prevent your order from being filled at the exact level you wanted.
Look, slippage is pretty much an unavoidable part of trading, especially when the market's going crazy or there isn't much trading volume. You can't just get rid of it completely, but, and this is the key, understanding it is the first real step toward managing how it affects your bottom line.
Okay, so what's really interesting here, and maybe a little surprising, is that slippage isn't always a bad thing. No, really. Let's take a look at its two very different sides.
And here you have it, the two sides of the coin. On one hand, you've got negative slippage. That's when your trade gets executed at a worse price. So you wanted to buy gold at $2,400, but you got it at $2,405. Ouch. But then there's positive slippage. This is when the market moves in your favor and your trade gets filled at an even better price. So you might get a better entry or exit point than you were even hoping for.
So what's actually happening behind the scenes to cause this? What's the mechanism? It really boils down to three core market dynamics.
Yep, these three right here are the primary drivers of slippage: high volatility, low liquidity, and execution delays. Let's break them down one by one.
Okay, first up, high volatility. Think about what happens during a big economic news announcement, like when a central bank speaks. Prices can just go haywire, moving so fast that they can gap right past certain price levels. This can mean your order gets executed at a completely different rate than you ever expected.
Next up, we have low liquidity. This happens when there just aren't enough buyers or sellers at the price you want, so your order has to go find the next available price level to get filled. You see this a lot in, say, thinly traded markets like exotic currency pairs, or maybe just during off-peak trading hours when not many people are active.
And the third one, execution delays. We're talking about milliseconds here, but even a tiny delay in the communication between your trading platform and the market can cause slippage because prices are shifting constantly. This is really where the quality of your broker's tech and their whole infrastructure plays a huge role.
Okay, so that's the what and the why. Now for the most important part, right? What can you actually do about it? Let's look at this from two angles: what a good broker can do and what you can do as a trader.
So, reputable brokers, they invest a ton of money in technology for this very reason. They connect to deep liquidity pools, from Tier 1 banks, and they use these high-performance servers located in major financial hubs. It's all about reducing the frequency and the size of slippage for you. But it's not all on the broker. As a trader, you have tools at your disposal too. It really comes down to choosing the right order types and just being smart and strategic about when you decide to trade.
Okay, first up, using limit orders. This is a big one. A limit order basically protects you from getting a bad price. It ensures your trade is only executed at the price you specified, or hey, maybe even better. Now what's the catch? The trade-off is that if the price never reaches your level, your order might not get filled at all.
Now you also got to be careful with stop orders. Here's why. Once your stop price is hit, that stop order turns into a market order. And in a really fast market, that can expose you to some pretty significant slippage between your stop level and where you actually get filled. So the lesson here is to place your stops thoughtfully, always keeping the current market volatility and liquidity in mind. So at the end of the day, slippage is just a constant in trading. It's always going to be there. But it's not really about trying to avoid it entirely, because you can't. The real difference comes from how effectively you prepare for it and manage it. It's all about navigating it with smart strategies and, of course, having the support of a broker who really prioritizes high-quality execution. Thank you for watching. If you got something from this, please like the video and support the channel by clicking on the subscribe button. That really helps us. Thanks again.